Jenny is a mortgage lender or mortgage banker. I'm a mortgage banker. Charlie is a commercial banker. And then Josh Householder is our chief banking officer and all kinds of other things. But anyway, but we're happy to be here to support you guys and whatever you need. I hope you enjoyed your lunch. Please get extra. You never know how much to order. I always want to order more than not enough. So we're very excited about our speakers this morning, or this afternoon, because it's almost afternoon. But we have Jon Rogers, and we have Nancy Strine, and we have Megan Krider, and they're going to talk to you about all things first-time home buyers. Just wanted to mention that CMB Bank does participate with all three of these fine people in their programs. Not every lender is able to do that, so definitely keep that in mind. And we just want to help you, help your customers find the best solution. So that's why we say we're right here. So we are going to have each of them give a 15-minute talk on their topic. And then after they are finished, we will open it up for questions afterwards. So please just hold your questions till afterwards. Write them down. We'll have plenty of time. So first I'm going to introduce all three, and then they're just going to take it from there. So Jon Rogers is here from Charleston, West Virginia. He is the Senior Division Manager of the Single Family Lending West Virginia Housing Development Fund. So let's give Jon a round of applause. And then we have Nancy Strine. Yes, Nancy Strine. I need my glasses, but I know Nancy. Nancy and I work together on the Home Consortium board. And Nancy is a local, and she is with the HAP grant, but she's also with the city of Martinsburg, and she is the CDBG and home administrator. So let's give Nancy a big applause. And then we have Megan Krider, who came from Pittsburgh. I'm not sure if Jon or Megan has a longer drive. I don't know. Did y'all know about that? Or
We didn't compare that.
geographically?
I came through the snow.
Okay.
I get more credit than
Yeah, I think you're
it's 5 hours.
right. He definitely does.
So Megan is with the Federal Home Loan Bank of Pittsburgh. She is their Community Investment Business Development Manager, and she oversees the First Front Door. She's going to talk about the First Front Door grant. So big applause for Megan as well. Thank you again for coming, and we're going to have Jon start it off.
So officially, good afternoon. It's morning, afternoon, whichever we are now. It's obviously a pleasure to be with you guys in Martinsburg and Berkeley County. I love getting a chance to come here. Gail and I did a thing in Charles County in October, so I was here not too long ago. We were with the League of Women Voters who did a session on affordable housing, and we presented and it's very similar to what you guys will hear about here. I hope you all know who the West Virginia Housing Development Fund is. I'll save the question for just a little bit later, but we are the state's housing finance agency. Every state has a housing finance agency. We are not actually, we're a quasi-government agency. We don't get tax dollars. The legislature gave us $5 million in 1968, and that's the last time they ever gave us any money. So we're totally self-supporting in our efforts. And those efforts are to support, create, and finance affordable housing in the state. We do serve the whole state. Last year we funded over 1,300 first-time home buyers to the tune of a little over $200 million. In Berkeley and Jefferson counties, there's 40 million that went into Berkeley and 20 million in Jefferson for 250 first-time home buyers. There's a ton of money to the two counties here. And so this is a very important part of our business, what we do here. Little tiny bit in Morgan County. We see just a very small amount, obviously, from Morgan for all the reasons that you all know, mostly supply, right? The average age of our borrowers for last year was 33, and average income was $54,000. Our average loan amount is about $150,000, and that's statewide. Again, you guys live here, you work here, so you know things are a little different here. Our average income for the two counties is $78,000 a year for the borrowers. Our average loan amount is $240,000. So again, quite different when we get over here. Of course, realtors are a huge part of our business, along with our lender partners. And between the two of you guys, you're our primary source of business referrals. So I will ask this with the show of hands, who has a client who's gone through our program in the last year or two? I mean, quite a few of you guys. I'm glad to see that. Thank you. But it also gives me an opportunity, and that's really what brings me out here as well. Certainly to say thanks for those of you that have done it, but also to educate those of you that don't know our programs. There's a ton of misinformation, of old information out there about our programs and what we do and don't do. So we'll spend a little time during my time here to just, again, educate you a little bit, but also clear up, put to rest maybe some old myths about our programs. I do have one, probably my most important handout, and it's this one. And if you don't have one of these, I know they're floating around here. You have more than enough coming up printed. Well, let me ask this. And the bankers can't answer, but who knows what a 30-year interest rate is? So not counting housing fund, but outside of us, what interest rate would you say somebody's getting today on a 30-year fixed rate loan? 6.5. 6.5? Okay, so in that ballpark, maybe a little bit higher in the last couple of weeks, because rates have creeped back up in the last couple of weeks. Yes, ma'am.
I'm going to mention something.
Okay.
So I'm currently under contract to purchase my first home.
You personally?
Me personally. And I'm
Congratulations.
using West Virginia housing.
Okay.
So that's great. It's an FHA, and our rate was 5.64.
Well, you know the answer to my question then.
So I didn't answer most of those, so I just want to say I'm going through it right
Okay.
now, and that's my experience, and it's been pretty good so far.
Do you care to share who your lender is?
Yeah, it's Homebuyer.
Okay. I had lunch with them yesterday.
Yeah, Kevin Patrick's my
Yeah,
lender.
I had lunch with
Great.
them yesterday. That's so again, I heard 6.5, maybe a little bit higher. Our interest rate's 5.64. The rate before that was 5.32. We'll probably have a new interest rate in about 30 days. So we work off of pots of money, and again, y'all do not want all this. I promise you. But we sell bonds on Wall Street, and that's the source of our capital, unlike the bankers who go to their vault and they pull out money, right? We actually sell bonds on Wall Street to raise the capital for our lending programs, and we do that really in tranches of bond money. And so the last bond sale we did was in 1st of December, and we ran through $60 million, and so we're gonna go get another $75 million from Wall Street here in about a month or so. And so that money, when we get that money, it has a maximum interest rate on it. Once we establish that rate, it can't be higher than that until we run out of that money, and then we go get another bond issue. So again, the handout, though, again, more so for those of you that don't use us, haven't used us yet. The top thing on there is really the most important, is the targeted and non-targeted counties. And so non-targeted are certainly the ones that we're sitting in today. And then targeted, it's pretty simple, right? You got 20 counties that are more developed and 35 that are less developed. All of our programs are based off of really IRS rules, which just seems funny, I know, but it's tax code stuff and it's federal housing policy. And so the IRS determines these numbers for us, and they determine what counties are targeted and non-targeted. And that definition has been around for more than 40 years, of the targeted and non-targeted. The incomes and the house price limits do go up and down. They went down some, certainly after the 2008 crisis. But they've mostly been going up the last 10 years. And so again, you can see what we're talking about. So non-targeted means you have to be a first-time home buyer in order to buy a house in our program. Targeted means you don't have to be a first-time home buyer in our program. And then you can see the household size, 1 to 2 persons or 3 or more. But here's this is one of the things that I want to make totally clear. So non-targeted and first-time home buyer excuse me, means that you just can't have owned a home in the last 3 years. So you get a free pass if you sold a house more than 3 years ago. You're again a first-time home buyer. You get out of jail free card if 3 years have passed since you sold your house. Gail will tell you there are a whole bunch of details behind that. Did I own a home? Did I not own a home? Divorce situations, heirship situations. The devil's in the details. So don't assume that somebody is or isn't a first-time home buyer until you talk to one of the bankers, one of the lender partners that do our programs and really get the details. And then unfortunately, sometimes the details don't come out until we're 2 months into the contract, and then they find out something new, and it's like, wait, they were divorced and they just sold a house like 3 months ago, and then they got married again. So those situations happen. Those are the nightmare scenarios, and they do happen. But again, on its face, 3 years past, you're a first-time home buyer again. The income limits then as well. So 1 to 2 persons, 3 or more. Again, this is a change we made about 7-8 years ago with respect to the income. So today, and again, this has been in place about 8 years. We only count the income, we only have to count the income of the people who sign the note and or take title. Okay, so a household can earn $500,000 a year, and if one family member, one borrower earns less than our income limit and qualifies, then we don't have to count the income of that other person that's in the household. But they also can't go on the deed. They have to stay off the deed. Even if they're married, we leave their name off the deed. Okay, so really important distinction, yes ma'am?
What are the 2 criteria again, that you have to agree with, be the one taking title and
Sign the note.
sign the note?
Yeah, be obligated for the debt, which also means we have to use your credit. We use that person's credit. But what we see a lot of times is, there might be a person who, typically one person has better credit than the other. And so if one person has that poorer credit, we can leave their credit off. But we have to leave their income off too. You can't have it both ways. You don't get to use their income and not their credit. So there, again, there's lots of ways that the bankers try to finagle that to make it work. I know I'm not supposed to answer questions during this, but you have your hand up, so go ahead.
Yeah, that really was just touching on what you just said, because I work with Eric Sear a lot, and
Yep.
I love the West
Eric knows
Virginia
our program really well.
Yes, I love the West Virginia Housing Development Fund. About 80% of my clients fit into this program.
Great.
So we utilize it a lot. As far as leaving them off the deed, is that a correction that can happen after closing? Is that something, or is that not?
Yeah. So we've seen folks try to very specifically break our program rules by going and reporting a new deed 30 seconds after the closing. That will cause us to call the bank and say, buy this, we're not going to buy your loan. It's a really bad thing when that happens. There's not, it's a great question, and I don't want to get too far away from my presentation, but there's no specific rule in the IRS code about that. And so where we landed on that is 60 days after. So the one rule that does exist is that the borrower has to occupy the house within 60 days of closing. That's an absolute. They have to occupy the house within 60 days. So what we've sort of said in response to that question is, after 60 days, you can do what you want, sort of thing. I mean, if you want to add somebody to the deed, okay, but do it 60 days after closing, and we won't get too excited about it.
I just want to make sure that we don't, like, our clients are obeying the rules too, because
absolutely.
Make sure, hey, don't.
Hey, people, we service all of the loans. We've got 17,000 loans that we collect payments for every month. And sometimes they'll call us and say, hey, I got married, can I add my new husband to the deed? Sure you can. Absolutely you can. Yeah, like I said, that's the official, unofficial answer is 60 days after closing. Everything's recorded. Make sure the deed's recorded, the deed of trust is recorded. For us, frankly, the final title, it would probably help, and you won't know this necessarily, but it actually helps if we have the final title policy back. For those of you that know what all that means. So, good question. So house price limits are house price limits. You know, they are what they are. They will, so you can see the date on this document is from June of last year. We'll get new ones about the same time this year, and they will typically go up a bit. So again, some of those misperceptions or myths about our program, that we have a whole bunch of extra forms for our program. There's 4. There's 4 extra forms. Simple as that. Gail, am I speaking the truth? Yeah.
Is that a typo on Jefferson for the house price?
It's not actually.
Oh my goodness.
No, it's
Wow.
pretty ridiculous, and also even somebody at $160,000 probably not gonna afford, I'm sorry.
They shouldn't be getting that loan.
Well, exactly, and somebody at $160,000 not gonna afford an 800, and now unless they got $400,000 to put down, and they could do that. They could do that. We have done a couple of $400,000+ deals in the last year. We did a couple that were 400+. Very rare, though. That's just not who we are. But no, good. Glad it is not a typo. Another one of those myths about our programs is that processing them takes longer than a regular loan. Again, the lenders do the process. You know, our lender partners do all that work. So it's on them. But from our perspective, there's no reason that it should take longer to do our loan than any other loan. There's 4 extra forms. The rules are the same. So it shouldn't take any extra time. We get this a lot. We're not HUD. We are not the low income place. We work with low income people, and in fact, Nancy's program and others like it around the state. There's one in the Northern Panhandle, there's one in Martinsburg, there's one in Charleston, Wheeling, that has down payment assistance money. Many of those borrowers use the city's money and get our mortgage as their first mortgage. Yeah, they can marry that up. Now, the city doesn't have a ton of money, so you're not going to do it's not a volume private business, obviously. But we absolutely serve folks that are below 80% of area median income. But we're not the low income place. I mean, we're not the poor credit place. Don't come to us with poor credit, because our rules are the same as the bankers. 620 minimum credit score. And now that's lower than some lenders, certainly, but 620 is the absolute minimum. Also, that we have a bunch of different rules about appraisals and property requirements. We have a few. And it's not very many. We require smoke detectors to be in the living spaces of the house. We require GFCI outlets in water areas. We do have, this is the biggest one really, and the one that again doesn't hurt too many in Jefferson and Berkeley. But 5 acres is the limit for our program. The house site cannot have more than 5 acres. That's a big one. We run into it from time to time. It's an absolute, it's one of those IRS things that we can't break. We have seen sometimes over the years that people buy the house and they cut out 4 acres and go with the house, and then there's 12 more acres and they buy it in a separate transaction that doesn't have any connection to our mortgage. That's allowed. We're just not going to finance it. The house and its site has to support the appraisal then. So again, it doesn't happen very often, because again, you'd have to survey the extra acreage, cut it out, do a separate transaction and all that. But it's not impossible. But just remember 5 acres. Also then handrail, again, one of those little things, handrails, I think I'm right about this, that more than 3 risers require a handrail. Again, I don't know if that's enforced in here, but that's I think that's statewide building code. I think that's right. Somebody know that?
Yeah, FHA will tell you if you don't.
Yeah. So if we see that on an appraisal, a lot of appraisers know that we care about that, and they'll put it on the appraisal. So again, it's a small one, but it's one that does come up. So lenders then, so you'll find our lenders on our website, it's whdf.com. Do a little digging for home buyers. There's a lenders page at the top, but then also again though, you'll see if you just search our program, home ownership program, and the lenders that do our programs are listed on our website by county. So it's a drop down, the lenders that are on there. We also have top producers, the top producing companies and top producing loan officers. We divided the state into the congressional districts, and so there's the top 3 lenders, top 3 loan officers, and for the first congressional district, the same thing for the second. So if you want to see who's really doing lots of our loans, you will see their faces and pictures and such on there. Another big thing, this is one that lenders that don't do our programs typically try to use against us, and try to really a fear kind of thing. It's something called recapture, that there's a recapture tax, and there is. It's part of the program. You'll see documentation about it. It's called, again, it's an IRS thing, and again, it's called a recapture tax. As far as I know, in the 50 plus years we've been doing mortgages, nobody has ever paid a recapture tax to the IRS. The IRS collects this tax, okay? And it has to do with the first 9 years of owning a house that is financed by one of our program loans. So if you sell your house that's financed with one of our loans in the first 9 years, then there's a little formula that you have to go through that says, hey, I might be subject to a recapture tax. It's a bell curve that starts at year 1 and goes to 4.5, it's the highest, and at 9, it's the lowest, and then it goes away. And it's a formula that's based on how much appreciation you might have in your house during that time frame when you sell it versus what it was when you bought it. And it also, though, a formula that includes what your income was when you bought the house and what it is when you sell the house. So you have to turn your, so this is the key to this thing, though. You have to turn yourself into the IRS. You have to tell the IRS that you bought a house that was financed by a mortgage revenue bond. It is actually an IRS form, you can look it up. Sale of my house financed with mortgage revenue bonds. It's an IRS form. You have to know when you sell your house that it was financed with one of our loans, and you have to file the form and turn yourself in. I've never seen anybody do it, and I've been working at the housing fund for more than 25, 30 years, between 2 different stints. I've never seen anybody pay it. Okay. So I would not let that fear, that misperception, keep me from getting a 5.64 interest rate, because it's probably not going to happen. But it is a form. The form's on our website. You can see it. I will say sometimes the closing attorney, the settlement agents, get a little bit excited about that form, and they say stuff at closing about it that's not really true. So that drives us a little nuts when we hear that. So that's why, again, it gives me a chance. Talking to you guys gives me a chance. We certainly educate the bankers that do our programs, and they know how to present that in a way that doesn't scare somebody off. Again, you're not going to pay it unless you have a very unbelievably rare set of circumstances, and you have to turn yourself in. There is no cross, I'll tell you this, there is no cross check between the IRS and us when it comes to that kind of stuff. That's all I have. I've probably gone a little further than I should have, and I apologize. Ask your, check with us, check with Gail and Janet. Our programs are out there every day. And we appreciate you using our programs, and I'll hang around for the rest of this, and maybe there'll be some more questions. So thank you all.
Thank you.
Okay, happy Valentine's Day, everyone.
Happy Valentine's Day.
I applaud you all for being here, because you can actually use all 3, like John said, you can actually use all 3 of these programs. Sometimes you can use them simultaneously, and I want to applaud CNB Bank. Gail actually uses all 3 for one person. So the key is to learn these programs and learn how to leverage them so you can get the most to help your home buyers. So I'll talk to you about our program, the Housing Assistance Program. It's been around for quite a while, but it's always kind of been the best kept secret, because I've been working on this going on 10 years, and we used to run out of money a lot. But right now we're flush with money because of the higher interest rate. We haven't been able to, it just takes longer for your potential home buyer to find the house. So, the process takes longer and with a higher interest rate. So, but it covers the whole eastern panhandle, Berkeley, Jefferson, and Morgan County, and the city of Martinsburg. And it's up to $14,500. First-time home buyer, the definition of the first-time home buyer. It's basically a deferred loan if the homeowner lives there for 5 years and basically keeps the property up and keeps the home insurance payments up. But basically we're the gap to help the home buyer buy that house. I have this handout, and what I did was I skipped to dwelling requirements because it's really very, these are some of the ways that we can help you. It can be single family, it can be a multi-resident. It can be a manufactured housing unit if it is on a permanent foundation. Be connected to permanent utility hookups and be taxed as real property. That's real important because I used to get a lot of those in Morgan County. Right now, Morgan County is, like John said, it just hasn't been real active. I mean, we have people coming in the first-time home buyers program, and they actively want to buy in Morgan County. I have this lady, I'm still working with them through Integrity, and she's on her 3rd or 4th home, but she got beat out by a flipper who wanted to get the cash up front, and he wasn't willing to help a nice home, first-time home buyer. So, they're still looking. She got a little more income from her job, so they can buy a little bit more house. But it's really difficult up there. Ever since COVID, there's people from DC have come up and taken up all around the houses along the river, so it's caused the prices to go up in that area, so it's really tough. But they're still in need, so we're there and we can help them when they can find that house. The other thing, it has to be occupied as the primary and principal residence. We cannot finance a land contract or leasing or seller's finance. But we can do we've had some people that have been renting their houses forever, and then they've been able to buy the house. The actual person that owns the home has come to see me, but that works out real well too. So, but it's for new construction and existing. So the last one I did was one of those new townhouses up in, near Spring Mills, I believe, yeah. Then the thing that's the hardest thing, and John mentioned it, we're dictated by HUD. So we have to do our income limits is what is really I call it my bugaboo. Because I just was working with a couple last week, and they wanted to buy in Berkeley, and with their combined incomes, I have to combine the incomes, number of people in the household, so I have to combine it. It's really hard for 48.8 in Berkeley County, so then what I do is I refer them to Johnsburg. So as long as they get the help, I don't care, we want to help these people for some homeowners. But, they can go to Jefferson County, and that's all because Jefferson County is in the SMSA of the Washington DC area, and Berkeley County and Morgan County is not. The only way I can get these changed is by writing a letter to the congressmen and the senators. I mean, I've asked my HUD rep, I asked my consultants, every time we have meetings, we try to figure out a way to get it to increase, but we're kind of like stuck. But we can make it happen if they meet those income. Then the next page is the actual housing units. and our housing limits aren't quite as high as West Virginia. For Berkeley, it's 247,000 for existing, 292,800 for new. Jefferson County is 285 existing, 292 new homes, and I know, because I live in Jefferson County, that those new homes that are being built are like 400,000.
Yeah, townhouses.
The townhouses, I mean, it's ridiculous. I do.
335, we see them every day.
I have one developer over there, in fact, when the League of Women Voters, they wanted me to come, and I said, well, the only problem is, I told Lynn, I said, the only problem is, I'm only working with one developer, he calls every year, he calls me every year to get these figures, because he wants to build affordable housing, and it's the same developer that built Briar Run. And he wants to build over there close to Rockville. And so people could actually ride their bike to work. But, the city of Ransom won't approve the development site plan because he doesn't have sidewalks and stormwater. And that's part of the smart growth requirements that the city of Ransom has required. So we're trying to figure out a way. I don't know if our access to home money, if we can give them money for the sidewalks and stormwater, but then you start doing that, you gotta do it for everybody. So we've got to try to figure out a way, but he's the only developer that I know that wants to develop affordable housing in Jefferson County.
But you can't have affordable housing when you have to pay for all the, sidewalks and all that.
I know, so, yeah.
Well, cost
I'm
money.
gonna get Ransom, to waive that, because they waived it for Briar Run, or they, and they keep building on and on and on. And during COVID, Briar Run was going crazy because they buy all their housing, all their construction, they had a stockpile. So when we had the supply problem, they didn't have the supply problem because they already had a stockpile. So, but anyway, one of the big requirements with our program is we require an inspection. So it's an inspection on top of your inspection, but I pay for the inspection. So how that works is, the next thing is, we go through the whole process, get pre-qualified by a bank or a mortgage lender, complete the home buyer's education program through Telemon, and they do that monthly, and I usually go to that at the end of the first or the second day and talk about the housing program, but we give examples, and again, we always run into the income, and then we refer to you. So you're present, even though you're not there, but, because you require that home education program as well. So, as long as the people are there, they can get the house. We had a really good class this month that most of the people were at least working with realtors and working with banks. Sometimes we have people that just show up on the class and hadn't even started the process. So at least this last class, we had some that were pre-qualified, that were actively looking, they'd already done that. So, and then I like to let them get pre-qualified first, and then come to me, and go to class, and then come to me, and then, be working with you to find the house, which takes the longest, I think. Once they get that signed contract, as soon as I get the right link, or get the link for the write-up, I can order the inspection. And if it's a city property, the city inspectors come out, and somebody has to be present in the house. They can't just go, they can't get the lockbox, and they have to be present. And then they'll write up what it is. It's basically safety and security. A lot of it is smoke detectors in all the bedrooms. Sometimes if there would be the steps, John mentioned the steps, if there happen to be 3 steps down there that might need a railing. On the porch, there might be a missing rail. There may be, I had one a couple of years ago that it was right across from Oak Street Park, a single dad. He worked in Winchester, a single dad, and it took him over a year to find that house because he kept getting beaten out by other people, but it took him a year. He kept updating his finances with me and the bank, and finally found that house. But the house was 1930-some, and only had one electrical outlet in the kitchen. So the city inspectors recommended they put in another outlet, because in this day and age, you know, it wouldn't do your toaster and your microwave and your blender, and you know, it was more of a fire hazard. So when there's something needs to be done, then we work with you all, and you work with the seller, and the seller then will agree to make those changes. So lots of times when it's just smoke detectors, lots of times you let the potential buyers just run to Lowe's or Home Depot and get them and put them in themselves. Or sometimes you all do that. It just depends, you know, it doesn't cost a whole lot. But that's why, then the seller got the other, agreed to it, so then they had put that in, so then the inspectors came back out. Then that is when, then I can actually reserve the funds. Sometimes that back and forth may cause a week or so, might have to do an addendum to the contract. But as soon as this contract is signed, I like to get that information, get the inspectors out there and get it done so that it won't cause any delays. Now with the county, Berkeley County, Morgan County, and Jefferson County, I have an inspector, and it's actually the inspector that works for Berkeley County. So for Morgan County and Jefferson, he does that on his own time. So he likes to do it on the weekends. So, you know, the sooner I can get that out there and get him to do that, the better. And that process just is a little bit different. He does things a little bit different. I share the information to you all so you can share it with the seller, get that back and forth, so we can get that approved, get that little bit of work done that needs to be done. And so, you know, you can get to settlement by the time you want to go to settlement. So it's just kind of a back and forth process. But I have noticed on some of, when the market was so flooded, that on some of even the sales contracts, there wasn't all that information. So the more information I have, the better. And then also, it used to be, you used to put your EMV checks on there, and I haven't seen that for a long time. So I get them early. I like to get a copy of that early because one of the big requirements, and I'm jumping around, oh, that's the next page. One of the big requirements of my program is I have to prove that the applicant has $500 in the transaction. So what I count as the $500 is either the EMV check, the check for your inspection, or the appraisal, but I like to have copies of that as a part of the loan processing. I can't wait till the very last minute when you go to closing and let the closing agent call. So that, if I get that ahead of time, that really works out well. So my period, affordability period, is 5 years or 60 months. So as long as the tenant, as long as the homeowner is living in there, keeping it up, but I guarantee you, we don't send inspectors out. We just try to tell them to keep the house up to par. And then it's written off as a grant. If something happens and they move, they break up, they get a job somewhere else, it's prorated. When, just like, let's see, I had somebody that bought, and during COVID, he was my first COVID person, a professor and was in Jefferson at Shepherd. He already sold it within 2 years. I guess they were going, his family was expanding, on a bigger house. I mean, the payoff was like $8,000, no qualms at all, because the price of the house had gone so that far up that it didn't make any difference to him whether they had to pay $8,000 back or not. It's prorated. The longer you live in the house, the less you would pay. So maybe if it's the 4th year, it might be just $2,000. And then there's homeowner insurance that's required. City of Martinsburg has to be the second mortgagee, or if we're involved with you all, sometimes we'll go back. Gail has so many in there, we'll go back a position just to make the deal happen, so. And that's only 5 years. I leave it up to the homeowner to keep track of that, because I have over 340 loans right now, and I can't keep track of all that. So they have to get, they have to keep track of that, so they may stop paying a little bit of extra. So, I mean, it's pretty easy. It's funded by HUD, so I have to follow HUD rules, unfortunately, but, hey, that's the way it works. But we try to make it easier for you. Best way to get in touch with me is email, because I'm in and out a lot. And I also have the community block grant program as well.
All right, well, thank you both. Gail, thank you for having me, and CNB Bank as our member, just really thrilled to be here. Board of Realtors, thank you for having me. So this is the right group of people that I'm hoping to speak with about a program that we have at the Federal Home Loan Bank of Pittsburgh called First Front Door. Has anybody heard of First Front Door before? Some, okay. Well, I'm glad you have. Great, I've done my job. So yeah, if you have heard about it, we do have some exciting announcements, and if it's new to you, then I want to run through the information we have. So again, my name is Megan Krider. I'm a Community Investment Business Development Manager with the Federal Home Loan Bank of Pittsburgh. My maiden name used to be Zumbrun, and it's like a very long name. That would have been the longest sentence ever if I had to say that. So while I'm based in Pittsburgh, I do serve all of West Virginia, as West Virginia is one of our 3 states that we call our district or service area. So West Virginia, Pennsylvania, and Delaware. So if you're not familiar with the Federal Home Loan Bank system, we are a government-sponsored enterprise enacted by Congress in the 30s. There are 11 of us in the country. We have a dual mission: support our members like C and B for their financial and liquidity and borrowing needs, and then also to support community development and affordable housing. So you were talking about the ill affordability of all of that. So we do actually have an affordable housing development program up to $1.5 million to support developers, because the cost of development is so crazy high, and then you're trying to rent or sell at affordable prices, and the math doesn't always work out. So we provide other types of grants and subsidies. But today, First Front Door. So I really do, I'm happy to be here. I will tell you that I have a favorite Thai restaurant in Pittsburgh. It's called Smiling Banana Leaf, and it was my favorite until last night when I ate Martinsburg Thai. My God, was that good. So you guys have some, and I always love just kind of experiencing the local businesses, so again, I'm happy to be here.
Gotta try Fin Time now.
It was between the two. Okay,
Yeah,
I will. We'll do like a dual,
We were better under old management, yeah.
Oh, interesting. All right, okay. So First Front Door, what is it? It does couple well. It can couple well with other programs. There's some similarities that you'll see, but there's definitely some differences. So it does take some creative work to kind of make these programs work. And for us, you do have to find the right person that would fit into each of these programs based on the different circumstances that they have going on. So First Front Door is a down payment and closing cost assistance program for first-time home buyers. We provide up to $15,000 of what is kind of similar, like a forgivable grant, if you will, if that home buyer puts forward $1,500 of their own equity. So it used to be $5,000 as of last year, but we have a lot of money available this year, so we've increased it to $15,000 per home buyer. Again, if they're inputting that $1,500 requirement. So that's a big deal for us. It's always been $5,000 since we opened the program a long time ago. The mortgage, though, it must be with one of, I didn't talk about who our members are. I'm sorry, I skipped over that piece. But we are, a government-sponsored enterprise. We work with our member financial institutions. They can be insurance companies, community development financial institutions, and credit unions. We exist for them, okay? So in order to participate, the home buyer has to get their mortgage with one of our participating member financial institutions. In West Virginia, we have 14 participating members. CNB is a very active and wonderful participant and partner on this program. The individual or couple purchasing the home, they have to be at up to 80% of the area median income based on household size using HUD income limits. So depending upon, and it's where they live now, not where they're buying. So that could be interesting. So if somebody's moving from somewhere else, looking to move, they may have higher or lower income levels, but that's something to take into consideration. So for a family of 4, right now, in Berkeley, you're looking at $60,950. I think that was on one of your hands-out that you have the income limits based on household size. So, I mean, I'm very aware your income limits are a lot higher under your program. So ours are lower. There is no wiggle room. It is just, you use the phrase I like, it's just the way it goes. I don't know. It's just the way it goes. So we're there too with that 80%, but this $15,000 coupled with other programs can really chip away at that huge lump sum of money that's required to bring forward. And that's what we're looking to accomplish. They must complete homeownership counseling, and then we have similar dwelling requirements to you. Basically, they have to live there. It can't be an investment property. If it's a duplex, they can't buy the whole duplex and rent out the half, but they can buy the portion that they're gonna live in. We're opening our program on April 16th this year. It's first come, first serve until funds are exhausted. This is planned just a little bit ahead of where we are, so I didn't want to miss this opportunity. So I unfortunately can't let you know until February 22nd how much money we have under this program. Last year we had $8 million. It will be substantially more than that this year, so a really great opportunity. We also are going to be rolling out another program in the home buyer space on February 20th, so still a little bit too soon, but if you are interested, I encourage you to take my card so that we can talk more after our February 20th and 22nd date when we're able to publicly release this information. So also that's a little bit interesting and different on our program is the home buyers do not apply. The participating member financial institution applies on the home buyer's behalf. So one of those 14 or CNB Bank member institutions I was mentioning, it's really the member or the financial person, the mortgage underwriter, that is processing the application, qualifying the income. So it's not like your clients, your home buyers need to come to us and speak with us directly. We have a website for that, which I will let you know about in just a minute. So if they are a grant recipient, the home buyer is subject to a 5-year retention, very similar to your funding there. If they sell the home prior to that 5-year expiration, there could be some prorated share due back. If there's a gain on the sale of the home, there's some math equations that we do. So it's possible, it's not frequent that folks are selling their homes within their 5 years, and it's not necessarily frequent that funds are being due back, but that is something that absolutely needs to be taken into consideration if they sign up. Another great thing that folks love about this program is the home buyer does not have to have a house identified upon getting eligible for this grant. They have 6 months to move forward, identify a home, and close. And we do consider exceptions or extensions to that timeline as well. We don't want to say, no, good luck, move forward. We will, provide some additional context or additional time there to get them to close. So that's like the home buyers going through their mortgage application process. That's when that member institution would want to apply to see if they would be eligible for our first front door funding. And we've already talked about it being in conjunction with other grant funding sources, and our funding works well because even though we have that lien on the property, we don't care where we are in the process. We just want to be at the table to support these home buyers. Our website is firstfrontdoor.com. That's kind of our home buyer public facing website, not necessarily from our financial institution and member partners view. So if you were interested and thought you had somebody that was in this space, you could refer them there. They learn about the program. They see the participating member financial institutions and at CFB, who the exact contact is at that institution of who they should specifically to reach out to about First Front Door, so they're not kind of walking in trying to do a cold call situation. So again, I'm sorry I don't have any handouts, but I do have this to hand out. So I'd be happy to give you my business card in the event you'd like to learn more about First Front Door. I really encourage you to check out the firstfrontdoor.com website because it really explains everything that I am mentioning. On our website, like the Federal Home Loan Bank website, it's a bit from our financial institution's perspective, but we do have some marketing materials that are flyers, and just so you have something to hand out and say, hey, you guys might want to check out First Front Door. But it is, again, critical. You have to do a participating lender, which is where a little bit of our overlap is not necessarily aligned. So it does depend on that and how the home buyer would like to move forward with their first mortgage. So those were the highlights I wanted to cover, and thank you again.
Does anybody have any questions for anyone here?
I have, because we were waiting, I don't know if I should do it on 3 different places. We'll work backwards. Okay, one quick question with you. So, first-time home buyers, will they also be qualified in the way that John was talking about, like a renewed first-time home buyer after that 3-year term?
Yeah, we say like a three-year term having a bought a home. It's a pretty a generous definition, if you will, not truly never having ever owned a home. There's a few different qualifiers, like if they are leaving a marriage and are now purchasing a home independently. So there are a few other qualifiers that could count as a first-time home buyer.
So they don't have to wait those 3 years
If they haven't owned a home in 3 years and we're looking to purchase the home, then they can move forward as a first-time home buyer.
I just had a list.
I was just gonna tag on to yours, because I just found in Maryland, if you move to Maryland, you're a first-time Maryland home buyer, even if you had a home in a different state. Is that true in West Virginia for these programs?
Not ours.
Okay, yeah, no, that's a weird Maryland.
Because we're gonna look at your tax returns.
Yeah, because, you tie that to your tax return. If you get
Maryland lost
tax
this
credit.
kind of grant money.
Right, it's just a weird, yeah.
And they do the same timelines. Okay. Now I've done lost my spot. Hold on 1 second. 3 years. So when it comes to like married couples, I know you were talking about for your program, John, if you're putting it under one spouse, the other one cannot sign on the deed. I understand that, but what if there's a situation where, say, current mortgage is under the husband and they want to look into purchasing another home and doing it only under the wife and not having the husband on that?
If we don't see if we're not looking at his income or his credit, then he can have whatever the hell he wants.
Yes, I was saying, yes, they can qualify as a first-time home buyer even though
If he's not part of the transaction, then he can own, Wall Street type,
Yeah.
Yeah, if we're not looking at his income and his credit, then we don't care.
But I'm saying
Maybe I'm not
like they're
here.
like if I buy a house, this house is in my name, but my husband's on the deed, say 2 years down the road, my husband and I need to buy another house, but I'm the owner, the current owner, I'm not gonna be on the deed or anything, but my husband will do the deed in his name for the new house. Like, is there a way that the spouse would then qualify for the first time home buyer since he actually did not own the house, like, didn't own the mortgage?
Yeah, well,
He was on the deed, he wasn't on the loan, so he was on the deed, would that spouse then
The
qualify?
deed still indicates ownership.
Yeah.
Right, okay, so.
Yeah, the deed's the primary indicator of
Right,
ownership,
but,
right?
yeah, so when it comes to the first home buyer, that's already automatic.
Correct, yeah. Good with targeting. That's all it takes, yeah. No buying.
And then I think that's, the other one got answered with somebody else's question, so I think we're good. Yeah, okay.
So how can we help our clients who already own a house to qualify for a new post? Is the best, just to make sure that I understood correctly, is the best way to go is sell a house, get hit by capital gains, rent something, and then in 3 years try to use the programs? Or how does it work? It's only for first-time home buyers who didn't own in 3 years, correct?
Or again, go to, they can buy in one of our counties that is a targeted county. Okay, so the county, the 35 counties on this side, you don't have to be a first-time home buyer. Now, it's not Berkeley, Morgan, and Jefferson, right? So send them to Pendleton County. At least you know what it is. Yeah. So for us, that's it. I mean, that really is it.
All right, it's going to be a very tricky question, and I just wanna make sure that this is possibility. So if me and my husband, we own a house, we're still unfortunately in our little first-time home. If we right now get my name off of deed, does it mean that I will qualify for the program after not owning a house for 3 years, or not?
So you're on the notes and the majority of the deed trust right now, probably.
Yeah, like we were just buying his veteran, we were buying,
You need a veteran?
Yeah.
Okay, that's a whole different, you just raised a great question. There is a veteran's exemption to the 3-year.
I was gonna ask that.
Yes. Yeah, so an eligible veteran gets to skip the 3-year rule one time.
Wow.
Is it,
I'm
just
glad you
yours,
mentioned
or is it?
Only for our, I don't know about theirs, probably.
I'm taking notes, so
Yeah.
take that.
Can I piggyback off that?
Yeah,
Sorry.
Can I piggyback off the veterans part is,
and they don't have to get a VA loan either.
yeah, I was gonna ask
They
if there,
don't
is
have
there
to
an
get a VA.
advantage to a veteran having a VA loan and being a new home buyer?
So some of you are gonna know this. There's one big advantage of the VA loan. They don't have to have a down payment. That is the primary advantage of the VA loan. Lots of veterans don't use their VA eligibility, they don't get a VA loan. So in fact, so a veteran can get an FHA loan or a conventional loan and still skip that first-time home buyer rule with us one time in their lifetime. Yeah, great question.
Yeah, that's good, especially for our area.
So, it was wonderful to hear from you ladies, because I had not heard about that. West Virginia Housing, if you need a campaign manager, I will sign straight up. West Virginia Housing is a wonderful program. I absolutely love working in it. I've checked with my clients because of and closing attorneys will sometimes call it the baby loan or the second mortgage.
Yeah, I can't believe I feel like an idiot sitting up here and not talking about our down payment assistance mortgage.
But when I follow up with all my clients, and when we first use it, one of the very biggest questions I had was, do you like it? How does that seem feel you? Because this is money that you are paying back. And every single one of my clients will love it. They're like, it's like 30, 40 bucks a month. I don't even see it. Small price to pay for 5.6% interest, which is when we first started, so it's good to see that went down. But on the realtor perspective of it, the only thing I would add, because I learned from my own mistakes, is on your offers, you do have to check off that second deed. You are opening up your home ownership with a second deed of mortgage type thing. There's like a little spot. Y'all know what I'm talking about? Okay, because I'm probably mistaken. But it is a fantastic program, and yes, deed is ownership. So if you can't go remove yourself from a deed because you can't own a home in the past 3 years. Your mortgage is not ownership, your deed is your ownership. I love it. I can't say enough good things about it. Front door seemed very, very, very interesting. Our local lenders really, like, when you're saying that they're applying for the buyer, I guess that's a conversation we need to have with the lender to see if our client would qualify for that, right? Like,
Yeah, so a couple things there. So we have 14 currently participating members in the West Virginia area that are listed there. The other half of my job, I'm here talking with you guys as community representatives and realtors in this space. I talk with our members too. So they're educated, they understand how to find and qualify folks. But we have over 40 members throughout the state of West Virginia, so if you ever come across one of our members, which is listed on our website, that don't use First Front Door, that's where I could come in and try to see if that's a program that they want to offer. Sometimes the feedback I hear about why the lenders aren't doing this is they just don't find the folks that qualify for First Front Door at those income levels, especially in this side of West Virginia. But that's why I'm here, is just to help with that education piece.
does it operate like the West Virginia Housing in the aspect that you can layer it on top of any loan? Like you can layer it with FHA,
Absolutely.
USDA. USDA, you say, oh, it's 100% financing loan. True, but I can use that $7,500 for a closing. So you can layer it over everything.
Gail
That's one of my
uses all
favorites.
three.
Yeah, I've done John, West Virginia Housing first, second, then Nancy as a third, and then it's not really a deed of trust, it's a
Grant.
Gail is the bomb.com. She made
We call it like a retention mechanism.
So say you get a loan at 5.6%, you said the going rate is right now for first-time home buyers, right? And the interest rates go down, like say a year and a half from now, you wanna refinance. Is there an issue with refinancing the first home buyer's loan?
We would do a recalculation to see in the event of a refi, but
Okay.
between, there's some proxies too, that it gets pretty complicated, so it's like I recommend just submitting all of the facts and circumstances so we could see what would we do back if possible, but we don't do a ton of those, I mean, it's a bit few and far between.
Okay.
But it is possible, we need to look into the math behind
So
it.
you can just
After
refi-
5 years.
you-
Oh, after 5 years, it's done.
But if within that 5-year period, they wanna refinance, then you do a recalculation, they don't have to go through closing again, do they?
We don't do any closing, it's all through our member financial institutions, so
Okay.
we don't have any additional underwriting requirements. It's, are you income eligible, are you a first-time home buyer, did you do your counseling?
Okay.
And then we're following our members' guidance on how they want to approve a mortgage.
Now, Nancy would have to subordinate their lien.
Yeah.
They would have to agree to subordinate.
I'm really glad you brought that up though, because that 5 years was the only eyebrow that I raised this whole time, because normally, people, you know, and this is an average, I'm sure it's not, you know, up, down, whatever, but they keep their mortgage for about 3 years. And
That's going longer by the day because of the low. So the last number I heard, 60% of the country has an interest rate below 3%. They're not selling their houses, and you guys know that.
And they're not
And they're not refinancing.
Right.
Yeah. Hey, let me just pick the folks, somebody, you all mentioned our second mortgage. I feel like an idiot not mentioning, you know, so the primary thing is our interest rate is, you know, is so much below the market. But the other piece of our program that's our real value proposition is our second mortgage program. And so we actually changed it the first of the year. Previously it had been $7,500 if you put 10% down, or less than 10% down, and $10,000 if you put more than 10% or more down. And so now everybody can get $8,000 on a second mortgage, okay? If you qualify for the first mortgage, you automatically qualify for the down payment. We call it our low down home loan, and it's a second mortgage, as Gail and others have mentioned. And it's a 2% interest rate, repayable for 15 years.
So you can roll it into your loan.
You absolutely, well, it's a second mortgage, it's a second mortgage. So you're making 2 payments, Scott.
Right.
Comes out to $52.
There you go. Jenny knows the number. Yeah, so like I say, we effectively, most of our folks only, you know, put low down payments, so they got only 7,500, and so we did raise it to 8,000 the first of the year. Yes, ma'am.
I just wanted to check on this. I don't know if that happened because that never happens with my clients.
What's
I
that?
have a client right now, a buyer right now, and she wants to pre-qualify. And she was telling me that she wants in West Virginia for the government, the closing costs or the down payment. And I checked with another lender in Winchester, and he said that only in Virginia can be done, not here. That not in West Virginia. And she wants that. She wants to get pre-qualified, but she said, I don't wanna put a down payment. I don't wanna put any closing costs. And I have a friend that the government helped him.
There's 100 programs out there. That's a tough question, really, because some loans don't have a down payment requirement. USDA insured loans don't have a down payment. VA loans don't have a down payment requirement. Every loan has closing costs.
Yeah.
Somebody's got to pay.
Yeah.
Yeah.
So they cannot do this. They
We have,
cannot even.
that's what our program is, now.
Our $8,000 of second mortgage money can go towards the down payment and closing costs. Nancy's 14,000 can do that. Megan's 15,000.
My program covers the down payment and closing costs. All the owner has to do is have $500 fixed value.
Yes, but they have to be income qualified in order to.
Yeah, you have to
do
do
So if she makes too much money, they can't help her.
Yeah.
Which might be why person in my family said that she couldn't be helped in the state of West Virginia. Because she might make so much money.
Yeah, but, I mean, there's the income.
Yeah, I mean, they can't do my program, they can do his program. Pretty much. The only difference is mine is when mine would be, okay, I work with a lot of people coming in for winter. I can tell you one day, I got 3 calls from Doyle. I swear, everybody from Doyle is coming up there. From Doyle, Winchester, you know, that's all. But anyway, mine's depending on where they're gonna live. Hers is where they live now. So if they live in Front Royal, that would be Frederick County. So that would be Frederick County, Virginia, would be what they qualify for. Mine would be, they're gonna buy a house in Berkeley County, it's Berkeley County. They're gonna buy a house in Jefferson County, it's Jefferson County. They're gonna buy a house in Morgan County, it's Morgan County. It doesn't matter where they come from, they're actually doing it right there. So that's the only difference.
Your $1,500 that the fire tank put in, is that including like home inspection, replacement?
Excuse me, can they talk a little louder?
Can you repeat your question?
She said, she wanted to know when my funds are gonna run out. They're not. I have $1.5 million. I never had so much money in this program. And I gotta get it out the door, or after 4 years, I was gonna take it back. Or we have to create another program. I have a strong amount of lenders here and banks here. The only program, I tell you, a lot of people get pre-qualified with Rocket Mortgage, and I can't work with her. I've tried, and I can't. I like working with the local banks and local mortgage companies. So all the ones that we mentioned today, Homebuyer, like the integrity, Strine lending. And then I also, the one thing I do, and I don't advertise it, but I also, some of those companies like Strine Lending, Homebuyer, now it's called UMH over there in the corner by Pill and Pill, Martinsburg. They do FHA 203Ks, and we can do the FHA 203Ks, where they go out and get a construction loan for up to $35,000, and I can wrap that in here.
Do most lenders recognize that, you know, you're available to them? I'm thinking of a client who had a VA loan and went to a local lender and went with the West Virginia.
Yeah, no,
But they didn't utilize you.
Yeah, I've had some problems with some VA loans. Some of them, Integrities haven't had any problem with some of the VA loans, but it depends on who's processing. There's a processing out of Missouri, and they will not allow a second mortgage use. And, you know, I've had two people that have started processing, and then by the time they get through the approval, they've turned it down. So I call that, whoever they're processing with, the Virginia, if it's VA Direct, I'll call them and I say, will you allow this? Will you allow our program to come in? And if they say, you know, I let them look at stuff, and because I don't want to let the poor applicant go through the process, and then he's got to cough up $4,000 for closing costs that he didn't know about. So I try to, but I've had that happen because we had 3 VA people that went to the home education classes, and we were all trying to help them. So I called, and the one in Missouri just won't budge. I've tried to get him to change, to help. So they have to borrow it from family, or come up with some other means.
Where would we find the schedule of your home buyer education classes?
They're every month at Telemon. It's Telemon Corporation. I have,
TELA-MON.
yeah, I have some of their contact information I brought. For March, it's gonna be March 10th, March 11th and 12th. It's usually the first weekend. but it's gonna be, it's, here, I can pass this around. Yeah, it's the first weekend, it's usually the first week, it's usually Monday, Tuesday, it's 5 to 8, it's $50 per family, $50 per family. And, here. I can pass a couple of these around. But, yeah.
With this lower rate, is there still a possibility of any buy downs, or is this like you guys still taking care?
No buy downs. In
Because I know
fact,
there was regular-
we don't allow lenders to charge points on our program, so there's no points.
All right, everyone, sorry, we have to wrap up, we have a meeting coming in, so I just want to thank Gail and her team for CMB for